What is a balance sheet? Don't worry, it's not magic. A balance sheet is a snapshot of what your business owns, owes, and what's left over. It's one of the three core financial statements, right alongside the profit and loss and the cash flow statement. Assets are everything your business owns that has value. For Alex, that includes their printer, laptop, some unpaid invoices, software, and a bit of cash. Remember, assets can be physical or digital. Even money others owe you counts. Liabilities are debts, money your business owes to others. It could be a business loan, unpaid bills, or taxes you still need to pay. Not all assets and debts are the same. We sort them into two buckets, current and non-current. Current means they are expected to be used up, sold, or paid within 12 months, like cash, unpaid customer invoices, or bills due soon. Non-current items last longer than a year, like laptops, long-term loans, or equipment you use for your work. This distinction helps show what's coming soon and what's for the long haul. Assets equal to liabilities plus equity. This equation is often referred to as balance sheet equation and will always be true. Think of it as what your business is truly worth to you. So, equity is what's left for you. Balance sheets follow a common structure. Here are typical categories you'll see, and don't worry, we'll explore each in future episodes. Let's break them down. Cash is the money your business has in bank accounts or on hand. Trade receivables, also referred to as accounts receivable, are money you've earned but haven't been paid yet. Inventory is goods you've bought or made that you plan to sell. Property, plant and equipment is things like laptops, office furniture, or machinery, long-term assets used in your business. Trade payables, also referred to as accounts payable, are bills you owe to suppliers or others. Loans or other liabilities are borrowed money you need to repay, short or long term. Owner's investment is the capital invested by you. Retained earnings are the profits your business keeps, or losses it builds up, instead of paying them out. As we've seen in earlier episodes, the profit and loss statement, also known as the P&L or income statement, shows whether your business made money or lost money over a period of time. It answers the big question, did I actually make a profit? Your income or revenue includes everything you earned. Your expenses are the costs you had to pay to earn that income. So, if you add up all your invoices and subtract your business costs, voila, you've got a profit. Or a loss, if the expenses were higher than the income. Let's break it down. First up is revenue or sales. That's the total money earned from your work or products. Cost of sales includes the direct costs tied to delivering your work, like materials or freelancers you hired. Gross profit is what's left after subtracting those direct costs. It's your earnings before the everyday bills kick in. Operating expenses are your regular business costs, things like software, rent, and marketing. Take those away, and you get operating profit. This tells you how well your main business is doing, before things like interest and taxes. Now, if you earned or paid interest, on loans, savings, or a credit card, it shows up here as interest income or expense. After all that, you get to profit before tax, or PBT. It's the money left over before paying the government their share. Then comes tax, the estimated amount you'll owe based on your profit. And finally, what's left is your net profit. That's your real bottom line. It's the number that shows how much your business actually made after everything else.
We've got the P&L for July done. Now it's time to put together my balance sheet.
As we've learned, the profit and loss statement shows how much money your business made or lost during a specific period. But the balance sheet? That's a snapshot of your business at a single moment in time.
So, my balance sheet will be as of July 31st. Remember that unpaid invoice for €1,000? That's money I've earned but haven't received yet, so it goes into trade receivables. And that software subscription I paid €2,900 for. Only €2,000 was used in July. The remaining €900 is for future months. That's called a prepaid expense and also goes on the balance sheet as a receivable. So in total, my receivables are €1,900. Plus, I have €100 in the bank. And I invested my laptop, worth €1,000, that's a fixed asset, or property, plant and equipment. At the same time, that laptop is also my owner's investment, that goes into equity. And don't forget, I made a €2,000 profit in July. That profit gets added to equity too, as retained earnings.
So what connects it all? The balance sheet equation. Assets equals liabilities plus equity. And now, equity includes your original investment plus any profit, or minus any loss, you've made. That's how the P&L and the balance sheet work together. The P&L shows what happened during the month. The balance sheet shows where you stand at the end of it. So the balance sheet equation can be extended as follows. Assets equal to liabilities plus equity, amount at the start of the period plus profit, or minus loss for the period. Your balance sheet shows your financial position. Are you growing? Are you in debt? Is your business healthy? It's like a health checkup, but for money. The P&L tells the story of your business, what works, what costs too much, and whether you're on track. Without it, you're flying blind. Together, the P&L and balance sheet help you make smart decisions. With these two, you're not just running a business, you're mastering it. Coming up next, how to plan for taxes, and make sure your business doesn't get caught by surprise.